Unfortunately, another thing that's probably adding cost to people's bottom lines is the Fed and interest rates. We've since the beginning of the year, the 10-year Treasury has doubled from about 1.5 to 3, just over. It's very rapid. 3 historically is not the end of the world, but the rate of change has been significant. With that, we know that there's obviously more Fed hikes ahead of us this year. So I'm curious to hear how folks, how interest rates are impacting folks' underwriting, how they look at acquisitions, how they're financing deals. And I'll start with David on that.
We're locking as much as we can. We've got some assets that are still in turnaround that really need to stay on a floater because they've got some value upside in the near term. That's probably where folks would get hurt the most moving forward over the next year and a half, is as prime correlates to rises in Fed funds and goes up dramatically. There's going to be some big increases in short-term rates. Fed's going to normalize, maybe go past normal into the upper 2s for Fed funds rates. So we could see other short-term rates 5 or 6%, possibly even higher. The long-term rates have probably peaked. I think a lot of folks have to think about how much leverage are they using. If you're at 65%, the increase in debt cost, is much more painful than if you're at 40%. And there are a few folks out there that don't use leverage, but it's painful for everybody, but more painful for those that are higher levered.
Yeah, the biggest question mark I've seen on the front end of these acquisitions is not so much today, but it's how to think about residual cap rates. So you have an environment now where you could raise 150, 200 basis points. What does that mean on your reversion 5 years out? How do you plan for an exit cap? And then discounting that back to today, that's a really tricky environment, whereas historically the last 2 years, you have a decline, 25 basis points, 50 basis points a year, generally pretty flat. You have a residual cap rate that's pretty consistent. And so penciling deals in an uncertain environment is tough. But I will say that commercial real estate traditionally has been a great hedge to inflation.
Yeah, underwriting is being strongly scrutinized in everybody's shop, I'm sure.
Yeah.
That exit cap rate question is also a duration question. If you're in the deal for 3 to 5 years, it's much more impactful than if you're 10 plus. So, everybody's looking at expenses, rents. You got to really look hard at your underwriting because it's a sea change.
Office, interestingly, obviously with longer term leases, and this is probably core to this discussion, is generally viewed to be a recessionary hedge because you can put something to bed and not have to worry about it for 5-10 years. The R word has come up quite regularly if the Fed keeps hiking. And so you've got sort of an interesting dilemma where if there's inflation, office might not be the best asset to hedge against, but with potential for recession, it is a good hedge. So how's that influencing folks' portfolios and how you're thinking about it? Anyone have some thoughts?
Well, we're a little contrarian on the lease. Our walt's going to be much shorter than just about all the other portfolios out there. It's a real granular tenant base, lots of short-term small tenants. So we've got the ability to push rate once occupancy's up, and we're less concerned about being locked in for longer term. If there is a recession, that's probably more of a threat to us, and we've got the ability to push occupancy and rents as long as the economy's hot.